Buy and hold investing. Purchasing stocks, ETFs, or other investment assets and holding them for a long period, often years or decades, regardless of market fluctuations. The core philosophy is that over time, the market generally trends upward despite short-term volatility. This strategy is ideal for long-term investors, especially those saving for retirement. Historically, the S&P 500 has returned an average of about 10% annually over the last 90 years. By holding through market ups and downs, investors can benefit from compound growth and avoid mistiming the market. For example, if you had invested $10,000 in the S&P 500 in 1990 and reinvested all dividends, that investment would have grown to over $150,000 by 2020. Importantly, frequent trading is avoided, which reduces capital gains taxes and trading fees. Buy and hold works well for patient investors with a long-term horizon and emotional discipline. It is not ideal for those who need liquidity or those easily swayed by market news and short-term losses. It's often paired with low-cost index funds and requires minimal effort once set up. Value investing. Value investing involves picking stocks that appear to be trading for less than their intrinsic value, often measured by financial metrics such as price to earnings, price to book, or discounted cash flow. Pioneered by Benjamin Graham and popularized by Warren Buffett, value investing seeks undervalued companies with solid fundamentals. For instance, a stock trading at a P/E ratio of 8 while its peers trade at 15 might be considered undervalued, potentially due to temporary issues that don't affect its core value. A value investor would investigate whether the discount is justified or presents an opportunity. This strategy is best for analytical investors who are comfortable reading financial statements and have the patience to wait for the market to recognize a stock's true value. Value stocks may take months or even years to rebound, requiring long-term conviction. Historical data supports its effectiveness. Over a 40-year period, value stocks have outperformed growth stocks in many global markets. However, during certain periods, such as the tech boom or other high-growth environments, growth strategies may outperform. Successful value investing hinges on identifying genuine value rather than buying cheap stocks that stay cheap. Growth investing. Growth investing focuses on companies that are expected to grow earnings or revenues at an above-average rate compared to their industry or the market. These companies typically reinvest profits rather than paying dividends and are often found in technology, biotech, or other innovative sectors. Investors look at metrics such as revenue growth, return on equity, and projected earnings growth. While growth stocks often trade at high P/E ratios, the idea is that their future growth will justify the premium. For example, companies like Amazon and Tesla delivered exponential returns over the past decade due to rapid revenue and market expansion. A $10,000 investment in Amazon in 2010 would be worth over $180,000 by 2020. Growth investing is suitable for investors with higher risk tolerance. These stocks can be volatile, and valuations can drop significantly if growth expectations aren't met. It's also sensitive to interest rates. Rising rates can hurt high-growth valuations. However, growth investing can offer substantial capital appreciation, especially in bull markets and innovation-driven cycles. Dividend investing. Buying stocks that pay regular dividends, typically mature, financially stable companies. Investors benefit from consistent income plus potential capital appreciation. Dividend yields are often used to compare opportunities. For example, a 4% annual yield on a $100 stock means $4 in annual payouts. Popular dividend stocks include blue-chip companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble. Some investors focus on dividend aristocrats, companies that have increased their dividends for at least 25 consecutive years. This strategy is excellent for conservative investors, retirees, or anyone seeking passive income. Reinvesting dividends can also enhance returns through compounding. The S&P 500's total return including dividends is significantly higher than price appreciation alone, about 10% annually with reinvestment versus around 6 to 7% without. Dividend investing offers relative stability but may underperform during high growth phases or when interest rates rise. Relying solely on dividends may miss out on newer high-growth companies that reinvest profits instead of distributing them. It's a sound choice for income generation and financial stability, especially when selecting high-quality, dividend-paying companies with a strong history of payout sustainability. Index fund investing. Buying mutual funds or ETFs that mirror a specific market index like the S&P 500, NASDAQ, or Russell 2000. Rather than trying to beat the market, index investors aim to match its performance at minimal cost. This strategy is ideal for beginners and hands-off investors. It requires little active management, offers instant diversification, and typically charges lower fees, sometimes as low as 0.03% in annual expense ratios. Vanguard's S&P 500 ETF, for example, is a favorite among passive investors due to its ultra-low cost and market-tracking performance. Historically, about 80% of actively managed funds underperform their benchmark index over long periods, making passive investing an attractive option. As mentioned earlier, a $10,000 investment in an S&P 500 index fund in 1990 would be worth over $150,000 in 2020 with minimal maintenance. Index fund investing suits long-term investors who value simplicity, broad market exposure, and cost efficiency. However, it's not for those looking to outperform the market or who want more control over individual stock selection. The key benefit is the set-it-and-forget-it nature, which eliminates emotional investing decisions and helps build wealth steadily over time. Dollar cost averaging, DCA. Investing a fixed amount of money at regular intervals, for example monthly, regardless of market conditions. This strategy reduces the impact of volatility by spreading purchases over time, ensuring you buy more shares when prices are low and fewer when prices are high. For example, investing $500 monthly into an index fund means you avoid trying to time the market. Over 10 years, you'll have invested $60,000. But the average purchase price will be lower than the average market price during that period, thanks to automatic price smoothing. DCA is particularly beneficial for new investors or those with a steady income stream. It helps mitigate emotional investing, such as panic buying or selling, and encourages consistent saving. This strategy is effective during volatile markets or when investing a large lump sum feels risky. However, if markets trend upward steadily, lump sum investing might outperform DCA. Vanguard's research shows that lump sum investing historically outperforms DCA about 2/3 of the time, but DCA reduces downside risk. DCA is best suited for disciplined, long-term investors seeking to build wealth gradually while reducing emotional and timing errors. Momentum investing. Momentum investing is based on the idea that stocks that have performed well in the past will continue to perform well in the short term. Investors use technical indicators such as moving averages, relative strength index, and volume trends to identify assets with strong price momentum. For instance, if a stock has risen 15% in the past month and continues breaking resistance levels with strong trading volume, a momentum investor may see it as a buy signal. These positions are often held for weeks or months, shorter than buy and hold, but longer than day trading. This strategy is ideal for active investors who are comfortable using technical analysis and monitoring the market closely. It requires quick decision-making and constant review of performance metrics. Back-tested strategies show that momentum investing can outperform the market in certain conditions. Academic studies showed 12-month momentum portfolios earning excess returns of 1% per month. However, momentum strategies can backfire in rapidly reversing markets and tend to underperform during high volatility or bear markets. They also incur higher transaction costs and tax implications due to frequent trading. Contrarian investing. When the majority is selling a stock or sector, the contrarian buys, believing the market has overreacted. This strategy relies on market psychology and value mispricings. Examples include buying during market crashes, like the 2008 financial crisis or March 2020 COVID-19 drop, or investing in unloved sectors like coal or retail when sentiment is overly negative. Contrarians believe fear and greed often lead to irrational pricing. This approach requires strong conviction, patience, and thorough analysis. It's best for experienced investors who can filter noise and withstand short-term losses. Warren Buffett's famous quote, "Be fearful when others are greedy, and greedy when others are fearful," sums up this philosophy. Contrarian investing can lead to exceptional returns if timed correctly. Investors who bought airline stocks during the early pandemic panic saw large gains once recovery took hold. However, mistiming or misjudging sentiment can lead to prolonged underperformance. It's hard to stay committed, but it can deliver strong returns when crowd-driven behavior in the market creates major gaps or swings. ESG, Environmental, Social, and Governance Investing. ESG integrates environmental, social, and governance factors into investment decisions. Investors seek companies with sustainable practices, ethical labor standards, and strong governance structures, often avoiding sectors like tobacco, fossil fuels, or weapons. This strategy appeals to ethically minded investors who want their capital to support responsible businesses. ESG scores help evaluate companies' non-financial risks and opportunities. ESG assets have surged in popularity. In 2020, U.S. ESG funds attracted over $50 billion in inflows, and global ESG assets surpassed $35 trillion by 2023. Performance has kept pace with or exceeded traditional portfolios, especially during downturns when companies with strong ESG practices showed resilience. Suitable for socially conscious investors, ESG investing balances returns with impact. It's also gaining institutional traction, with pension funds and endowments adopting ESG frameworks. However, standards and scoring can vary, and greenwashing, exaggerating ESG claims, remains a concern. Investors should perform due diligence or use verified ESG funds or ETFs for exposure. Swing trading. Swing trading is a stock market strategy that aims to capture short to medium-term gains in a stock over a period of days to weeks. Unlike day trading, which involves rapid trades within a single day, swing traders hold positions longer to take advantage of expected price swings. Swing traders use technical analysis, chart patterns, and momentum indicators to identify entry and exit points. A trader might buy a stock after a breakout above a resistance level and sell once it reaches a target price or shows signs of reversal. This strategy is suitable for investors who can dedicate time to market analysis, but prefer not to trade every minute. It balances risk and reward by capturing shorter-term trends without the high stress and time commitment of day trading. Statistically, swing trading can deliver returns higher than buy and hold in volatile markets by capitalizing on frequent price fluctuations. However, it requires discipline, risk management like stop-loss orders, and emotional control, as positions can quickly turn against the trader. Costs such as commissions, taxes on short-term gains, and potential slippage must also be considered. Swing trading works well for investors with moderate risk tolerance who want to actively manage their portfolio but still retain flexibility. Asset allocation, diversification, spreading investments across various asset classes, stocks, bonds, real estate, cash, commodities, to balance risk and reward according to an investor's goals, risk tolerance, and time horizon. A classic model is the 60-40 portfolio, 60% stocks for growth and 40% bonds for stability. Diversified portfolios help mitigate risks. When stocks fall, bonds often rise or remain stable, smoothing overall returns. Proper diversification can reduce volatility and improve risk-adjusted returns. For example, during the 2008 crash, diversified portfolios lost less than all stock portfolios and recovered faster. This strategy suits nearly all investors, especially those with medium to long-term goals. Asset allocation can be customized. Younger investors might favor 80% stocks, 20% bonds. Rebalancing, adjusting allocations periodically, maintains the desired risk level. Tools like robo-advisors automate asset allocation based on user preferences. Diversification doesn't guarantee profit, but it protects against major losses from any single asset, making it a cornerstone of smart investing.
In nomine Patris et Filii et Spiritus Sancti.